As interest rates continue to rise, house prices continue to fall. For 6 straight months now, home values are down across the country, dropping 1.2% in October alone. CoreLogic data shows Brisbane leading the declines. Property values falling 2% over the past month. Others, Sydney, Hobart and Canberra, all dropping by more than 1% in the month. For more analysis, let's bring in Tim Lawless. He's the head of research at CoreLogic. Tim, thanks for your time. Basically, house prices will continue to fall until those rates hit a ceiling. Is that a fair way to put it?
Hi, Kieran. Yeah, I think that's probably a reasonable assumption. That's been our view all along, is that the housing trajectories are very much intertwined with the interest rate outcomes. So hopefully we're getting pretty close to a ceiling in rate hikes, although it's fair to say there's a lot of uncertainty about that as well. So, so far housing prices are down about 6% nationally, a lot more than that in Sydney, where they're down 10.2%. So quite a bit of diversity around the country.
So give us a bit more detail on that diversity, what you're finding state by state.
Well, as you mentioned, Kieran, Brisbane is now the weakest market amongst the capital cities and the regional markets. Housing values are down 2% over the month, and they're about 6.2% below their peak. But most of this downturn has been worn by Sydney so far. Of course, Sydney peaked a little bit earlier. The market peaked in January, well before interest rates started to rise. And we've seen housing values there fall by a little bit more than 10%. But the context is really important. Everywhere has seen a pretty decent run-up in housing values. Sydney, for example, was up about 28% through the upswing, and now we've seen this just over 10% drop. So in dollar value terms, we've seen about a $250,000 rise in values through the growth cycle, and now the market's down about 118,000 across Sydney. So the relativity of that upswing is really important, because we are seeing values in some markets like Sydney falling at the fastest rate that we've seen on record.
And when you look at that upswing, where does the pricing sit today in relation to pre-pandemic?
Well, if you look back to, say, March 2020 levels, every broad region around the country is still showing values above that level. You can go to somewhere like Sydney, for example. We're still seeing in Sydney housing values nearly 12% above where they were in pre-pandemic levels. But Melbourne, on the other hand, only has about a 3.6% buffer on where values were back in March of 2020. This is because Melbourne had a sharper downturn earlier in COVID. Housing values fell nearly, about 5.5%. Between the onset of COVID and about September of 2020, Melbourne got hit a lot harder with lockdowns and so forth. And then values didn't rise as much. They were up about 17.3% through the upswing, and now they're down 6.4%. So when you look at some markets, they don't have as much buffer as others before they return to pre-COVID levels. Go to Adelaide and you'd need to see housing values fall by more than 30% before you're back to pre-COVID levels.
And when you look at the buffer, you use that word, I'm interested in your analysis when it comes to mortgage holders, because banks do their stress testing on loans and when they're loaning to first home buyers and so on. But now we're nudging above some of those stress tests, aren't we, in terms of this rate cycle?
Yeah, I guess you're talking about the serviceability assessments at the time of the mortgage origination. So before August of 21, borrowers were being assessed to repay their mortgage at 2.5 percentage points above the origination rate. After October 21, or from October 21, they were being assessed to pay 3 percentage points above. So for anyone that took out a loan prior to October of 2021, we've already seen interest rates surpass that 2.5 percentage point buffer. And we're getting pretty close to the 3 percentage point buffer as well. We just need to see another 25 basis point rate hike, which is looking almost guaranteed, I think, before the end of the year. So once we go beyond those buffers, I think it's fair to say that some borrowers will be moving into uncharted territory around their ability to repay their mortgage, especially when you consider what's happened with inflation and the fact they probably haven't budgeted for the cost of food and utilities and fuel, for example, being as high as what it is now, along with such higher mortgage costs.
Tim Lawless, Head of Research at CoreLogic, thanks for your analysis. Appreciate it.
Thanks, Kieran.